here we go again. Today, I'm going to talk about a very important topic, but a little bit different than I used to. And this is because we are ahead of 2023. And for this event, I need to explain to you what could happen in each scenarios of the outcomes. So today, we're going to have a look why this will be the most important week of the year. And secondly, how to choose the right market sectors for the upcoming period in the possible scenarios. So technically, about the next week macro data, we are going to receive the UK Economic Disaster Barometer and EU rate decision, which would be more than enough already, but we're going to get US inflation data over several days, and the Fed is watching. In fact, watching very closely and will determine its decision after receiving the fresh inflation data. So in my chart, you will see three major points. The yellow line is the CPI itself, which as you can see the last month was in increase, while the pink line representing the underlying inflation. As you can see last month it was stagnating. I brought the oil price on the chart with the blue line, which representing the energy prices at the moment, and with the green line, I would like to represent the stock market. So as you can see, last month's CPI, as I mentioned, was in increase, not so much, but it's already increased. And if you compare the CPI and the energy prices, you can easily see that the only reason why the CPI was in decline since last year is indeed the declining energy prices. However, the underlying inflation data shows continuously rising trend, and the last month was only stagnating, but there is no sign of decline at all. While the energy prices were declined for over a pretty good period, but it is in increase since July this year. At the same time, of course, we all know about the AI mania hyped stock market. It's not really the stock market, but just a couple of stocks on the market, actually. So, what we need to have a look on this chart really is what happened from 2021 November, which is that first white line. As you can see, all three major effects crossing the point of the economy damaging status. And the economy damaging status represented with this green horizontal line. That was the point when the CPI, the energy prices, and the underlying inflation as well started to increase above a level, which level is technically damaging the economy. So the CPI was already too high above this level for a healthy economy. Also, the underlying inflation increased with the CPI, and we got the energy prices also way too high at this point. Now, since we got the supply chain disruption, these three major effects was definitely a very bad message to the market. And this is why, as you can see on the green line movement, the stock market was reacting on a negative way for a very long time. Now, as you can see, that was the moment of the wake-up call for the companies, because companies realized at that point that the hard times just about to come. And the plan of the math is just begun, which means make the numbers great again. So all companies started to work on revenue and income surgeries, showing the numbers that they are very nice. But because they started to work on this on the background, the market started to panicking at this point. So as we can see, the market decline lasted until December of 2022. So from 2022 December until today, what we had is fairly low average energy prices. And this gave a perfect chance for governments and companies to provide a narrative which trying to say that everything is fine, the world is not burning, everybody is going to survive. Now, the revenues showed a very good increase after cosmetic surgery, but the real income and revenue did not improve, but there was chance to make it look nice only. But anyhow, the market believes to the narratives from companies and governments, and they started to buy. That was the time when the AI mania kicked in. However, the last time we saw any sign of the smart money and larger investors was November 2021, and since that time we realized the market is rising, but there was no sign of them at all. So just to understand the current situation, right now we have increasingly high underlying inflation, while the real CPI is just about to start rising because the energy prices started to rising. Now the correlation between the two is very important because the only reason for declining CPI was the energy prices. And so while the energy prices were down and the CPI managed to decline, that was the only time that the stock market managed to go up. But what would happen if something changes? And this is the change what is about to come next week, because we're going to get the inflation data. And the inflation data is very important for the next Fed rate decision. But why is important? So let's talk about a little bit what could happen if there will be another rate hike. Now, this means faster damage on the economy, but at the same time, faster recovery. If the rate hike pause will kick in, then we can expect for slower damage, but slower recovery. So for the long run, the stock market would suffer for a longer period. Since last rate decision, we're waiting for 2 waves of inflation. The first came out with an inflation increase, but the second is about to come next week. So there are 2 scenarios in that case. The first scenario is increasing inflation data. The second is decreasing inflation data. So I don't want to make any prediction. Or, well, I do, but my prediction is that the inflation is rising. But I want to talk about both of the scenarios because this is important to say that getting a declining inflation is not impossible. It's just very unlikely at this point. So what would the economy need for lower inflation? Which means it should be already experienced now. Only one thing is enough for that, which is lower prices. But that means more consumer spending, more income for companies, not increasing energy prices, and a decline in underlying inflation. So, do we have more consumer spending? No, not really. In fact, we have less consumer spending, and if the tightening period gets longer, that means that this time is just getting longer and stronger. Do we have more income for companies? No, not really, because we already realize that companies are just playing with the math, but they don't really have the increased income. In fact, those incomes and revenues are declining, and probably the next earnings will be a very sad one. So we don't really have too much chance to get this, but do we have declining energy prices? Well, indeed we don't, because this is not only rising, it's building the price structure to the upside. It doesn't look like it wants to stop anytime soon. And then lastly, do we have underlying inflation which is declining? No, not really. Truly, we have a stagnating underlying inflation, but at the same time, if the energy prices are rising, everything else could be rising within the inflation. So these are the points what we would need for lower prices. Now we know that we don't have these ones, but just for the sake of this video, let's say we have. So if this would be the case and we're gonna get decreasing inflation numbers on the next week, how this could affect the stock market? Now, if we're talking about where is the good performance expected, I would say that in sectors sensitive for consumer spending. The not so good performance would be experienced within the safe haven and bond sectors. But what would the economy need for higher inflation? So again, this should be already experienced if we want to get higher inflation data next week. Well, again, just one thing is enough: increasing energy prices. But in this case, we're supposed to have less consumer spend, less income for companies, further increasing energy prices, and increasing in underlying inflation. Now, do we have these ones? Well, we definitely have increasing energy prices. We do have less consumer spend and it's just slowing even further. We definitely have less income for companies, therefore for people as well. And we more likely have further increasing in energy prices. So increase in underlying inflation is almost guaranteed. Well, it's not guaranteed for fully, but it is almost guaranteed. So if this would be the case, which is more likely than the first scenario, then the not so good performance would be around sectors sensitive for consumer spending. Obviously, because consumer spending sensitive companies are expected to perform pretty much bad. But the good performance would come from safe havens, bonds, and essentials like utilities, healthcare, etc. So let me just explain that a little bit further. Let's say here is our green line on the chart representing the stock market. Now, what if inflation declines next week? This means the price expected to stagnate or increase further. So what to do in this case? we could apply short-term buy positions if the economy stays unstable. And we could do long-term buy positions, but this is risky because of the still unstable economy, on essentials like utilities, healthcare, etc. But what if the inflation increases? What to do in this case? Well, we got options. Depends on the balance of investments, how much stayed in the market between essentials and bond and or safe haven assets. So short-term short positions on essentials and short or long-term short positions, which is risky again, on companies with high consumer spending sensitivity. But why would we do this? Now, I was talking about possible market reaction in a trend-like manner. This means when I'm talking about what if the inflation increase, means what if the inflation increase in the next half a year, maybe. So in that case, we can expect some trend-like movement. But as I mentioned, especially with the essentials, we are better shorting these on a long term or go long with long term but long other assets on short term. That depends on what scenario we're going to get. But the reason why is that if the inflation really comes out increasing and the market happens to be reacting in a very negative way, the sell-off will affect almost every market sectors. But market sectors with less sensitivity on consumer spending, like essentials, like utilities or healthcare, is likely going to decline a little bit less or on shorter term than other companies like tech companies. So we can short these companies, but only for short term because there is a huge chance that they're going to stop falling and maybe start to increase while the rest of the stock market is keep falling. So the trader effect is different and we need to take that in consideration. So when you're trying to choose what to do on the market when the inflation package is coming out next week, first of all, you need to decide for what term you want to trade. And this is the most important thing you need to think on. But while you do that, I would like to explain a little bit of help to choose the right market sector for you so you will not mess this up very, very badly. So first of all, I'm going to detail two scenarios, obviously declining inflation and increasing inflation. So if we take a look what could happen with declining inflation, but again, this is for longer term declining inflation. So if the inflation and the underlying inflation also start to decline, and we could say the energy price is starting to decline or stagnating, so technically the damage is over and we just start to improve. Well, we need to talk about two waves and we need to talk about market sectors. Now, this is not all the market sectors, obviously, but I'm just trying to detail the most important ones. So the first wave would be within a weak economy, but with positive market reaction. So try to imagine that the inflation package is just coming out next week positively. So that means the economy is still weak, but we are seeing the light at the end of the tunnel. This is a good thing. So what would we expect? Well, consumer sensitive sectors would react very positively because the market tried to price them in on a positive way because they probably will be out of the woods. But essentials like utilities, healthcare, and etc., they would reacting on a positive way either because they obviously start to produce a little bit more things. But then mining and production would be stagnating somehow. But why? Now, well, that's because the economy is still weak. And in order to get the economy to a stronger stage, first we need to start improving mining. But start improving mining starts with creating the environment for the improvement. So the first wave would not be very, very effective on these sectors. But safe havens that would definitely slightly go lower because obviously safe haven is to save investors. And if investors don't feel safer somewhere else, like in riskier stocks, for example, then they're going to get the money out of safe havens. Now, safe havens not only protecting the money, they're moving for other effects as well. And that's why I'm not saying that they would probably just fall to hell, but probably declining a little bit. Also, still within the first wave, the non-energy related commodities would most probably decline. If we want to improve the economy, we need lower prices for commodities, that's for sure. So therefore, those charts would be just going to hell. And energy related commodities also, but don't forget something. The last 3 years was very damaging for smaller companies. So most probably companies with very bad performance would probably still decline because they cannot produce more because the economy is not improving just yet, but only the inflation is starting to improve at the beginning at least. And now there will be the second wave, which means improving economy, mixed market reactions, which is including corrections and earnings sensitivity in this period. So the consumer sensitive sectors would be declining on the second wave a little bit. And that's just because this is what charts are doing. So they just making corrections because the economy works in waves, and the second wave is trying to improve the economy. But when we do this, the performance of the companies are declining a little bit. So essentials like utilities and healthcare would be stable, most probably stagnating. But mining and production would start to shoot to the stars because this is the period when the economy is improving. So we really need the mining and we really need the production. Safe havens, however, at this time would be go to sky high as well, because most of the safe haven is not only for protecting your money against inflation, but also they are industrial metals. So non-energy commodities would be just keep declining because obviously we need all the resources for less money. But the energy commodities would shoot high. And that's because the energy sector is a very dirty sector. And obviously they just creating money out of everything. If the demand is increasing on the energy commodities, then the energy commodities would shoot a little bit higher. But there is a difference between energy commodities going higher at this time or energy commodities going higher in the time when the economy is improving. Two very different scenarios. One is healthy, the other one is less likely. And obviously, bad performance companies would just perform badly, same as before. But what if the inflation is not declining, but the inflation is increasing? Well, in the first wave, which would mean weak economy and negative market reaction, consumer-sensitive sectors would go down. Essentials like utilities, healthcare, etc. would go on sideways or just a very little bit down. And as I mentioned to you, if there is a sell-off, then these companies like utility and healthcare companies would react with the sell-off as well. But as I explained, they probably stop a little bit earlier than everybody else. So mining and production would go down because obviously this is not the time to improve the economy at this stage. And safe haven would just shoot to sky high because investors trying to protect their money. So non-energy commodities would go sideways, but energy commodities would go to the upside because obviously this is inflationary period. So bad performance companies, you don't need to guess, they will probably go bankrupt. And the second wave, improving economy and improved market reaction is expected. So the consumer sensitive sectors would start to stagnate on a very low level. This is very likely the scenario what the crypto assets are doing in the last couple of months. So essentials like utility, healthcare, etc., they would just keep probably stagnating, but at this time maybe we would experience some increasement as well. So mining and production would shoot to the stars because obviously this is the economy what we are about to improve right now. And safe havens would start just stagnating. Not a sell-off, but the sell-off probably would follow it. Non-energy commodities would just go down because, as I explained before, in order to improve economy, we need cheaper commodities and also cheaper energy commodities, which would just shoot to the stars again after in the third wave. And obviously, we would see at this time a lot of bankruptcies as well because companies just cannot survive what happened before. So I think this is clear where you need to thinking when you want to choose something. Well, you could short the market, but if you are lazy to learn it or you just don't have the time or you don't want it, then obviously you will keep searching the buying opportunities. There will be buying opportunities, but there will be very risky times as well. So in case of increasing inflation, you could be safe, pretty much safe, with the safe haven assets and the energy commodities. But afterwards, you need to be careful because if the second wave is coming, those most probably start to decline. So I hope this will be a very useful preparation for you for the next week. And I really hope that you are ready because Jeremy Powell is ready. He is waiting for these informations, and this is how he will make his next decision about rate hikes. If you're worried, just stay tuned. If you need more details, go to the website, sign up for the pro membership, and you will get everything, whatever you need in market analyzation. I'll see you there or in the next video. Bye.